Hey everyone, and welcome back. This is Kirk here again at Option Alpha, and this is the weekend video update. And now I got to be honest with you guys, this is going to be really important for you to watch this video in its entirety because I'm going to go through a lot of things on this video that probably you weren't aware of at the time. But now looking back, hindsight's 2020 as always, and I'm not trying to toot my own horn here. But I just want to make aware to everyone, as I do with all my coaching students. Anyone who coaches with me knows I do this religiously. My analysis is very easy. I don't use too many technical indicators. I don't use too many analysis features, and I usually stay on the side of using the very simple and consistent analysis tools for determining where the market might go the next over the next couple weeks. Now, I'm actually going to show you a couple posts here because, like a lot of people, I've during this whole rally, whatever, over this last 2 to 3 months, I've been getting a lot of people saying, that PEs are still really low for stocks, and that this rally is justified. And look, I don't dispute that stocks may be a little bit underpricey overall historically, but I really think that it's gotten a little bit out of control with this rally. I think Friday's nice sell-off was a good indication of things to come for the next couple weeks. Heading into the end of January and into February, I think stocks are going to continue to sell off and be in this correction mode that we're going to start to see. And I think that the signs were clear before, and I just want to again point those out to you. So it's really important that you watch this video in its entirety. So this is the post that I actually did, warning of the top is near, and this was back on January 14th. Now, in this post, I talked about how times before we had alerted to market bottoms using sentiment indicators, i.e. bullish and bearish sentiment indicators. And what the gist of this video that I did back on the 14th is that when bullishness gets to extreme levels, that you want to be out of stocks. When everyone is buying, you don't want to be buying, right? When everyone's selling stocks, just like the bullish indicators were at extreme lows, and we had alerted to that way back when this thing was getting started, that you want to be in stocks when everyone else doesn't want to be. And then we did a post on January 20th. This one was a really good one about the consistency in the Dow. In the streak that we were running is about 37 days without a 1% decline or more. And that's usually followed historically by a 1 to 2 month sell-off, driving the indexes down on average 7%. So that's what we could be starting right now. Now, I showed you guys two different charts on that same time period. This was back when the market started its major sell-off in April of last year, and you can see how there was just, I called it cracks in the hull. And now we have started that progression back on the 20th, and I think that we've actually completed that with a nice trend line break here on Friday. Now, the last one that I wanted to show you guys is this video that I did just the other day, about 3 days ago, talking about the VIX. And I actually have the video up here, so I'm going to increase it to the full size of the screen here, and this is going to be the actual video that I had done before about the VIX. So I just want to play this real quick for you guys. The VIX is really setting up for a huge move. One, because I think we're starting to see a little bit more volatility on the upside. We haven't even seen the VIX cross into, God forbid I even say, the 19 range for the last 2 months here. So last time it was at 19 was back in early December. Now it just crossed above there last week and starting to inch up there this week. So I think that the VIX could be telling us that we could have maybe a short-term top in place. You can see that we definitely. Okay, so you guys have already seen on this video that I did before that the short-term top was in place. And let's go to a chart of the VIX right now so that we can see what kind of move it's had since then. And there you go. So our video analysis that we had done before, again, we were looking for a big move in the VIX, and look at that. I mean, the VIX was up 24% on Friday, and that's what we were looking for. Again, this is breaking out into a new region for the VIX. So if we look back historically and check out what happens when the VIX makes these types of moves, you can see that there could be a lot more upside potential in the VIX, which means that the indexes could get hit pretty hard in the coming weeks. So you just want to be aware of this. This is going to make option premiums really swell on either end of the spectrum here, which is great for option sellers like us. But you just want to be aware of this going forward. Now, if we take a look at the Dow here, and I did a little intraday chart here. This is an intraday chart of the last 60 days for the Dow, and you can see that this was the trend line that we were very, very steadily following. And it seemed like we were hitting it more and more and more as time went on. And now we've definitely, absolutely 110% broken that trend line, a very swift break of that trend line. You can see it cracked right through it. So what we'd expect going forward for the Dow and for the rest of the markets is possibly next week a slight rally and retreat and retracement back to the underside of this trend line. So possibly back up into the 1190s type region before we continue lower. And that's really going to bait in a lot of bullish traders and investors thinking that the rally is back on. Okay, everything's fine. And then the smart money is going to come in and just kind of crush this thing and sell this thing off. So I think that's what we have going on for the Dow over the next couple weeks. Just real quickly before I end this video, I wanted to take a look at the S&P. I think it's important sometimes to, although I don't always do this, just as a good frame of reference, I like to draw Fibonacci lines like I've just done here. These are the Fibonacci retracement levels from the most recent low of this rally to the most recent high. Now, typically I like to draw these over 2 to 3 year time period, but I think this gives us a good little perspective on where the market could fall in the coming weeks. So I think that the major areas is right around here, around 1240, 1235. You can see that also coincides with this former top here in November. So right in this general region, 1235 to 1240, I think the market could find support. If it cracks below that, then obviously the 50% level, which would be right down here around 1170. So I think we have a really interesting setup going on in the markets. I would definitely start to really get out of your long positions. I've said for the last 2 weeks to buy out of the money puts as a hedge. Those have really become profitable on Friday. Even if you bought those 2 weeks ago, those are profitable trades. So as always, if you have any questions or comments, please contact me, and happy trading.